Most people think Bitcoin's biggest battles are happening on price charts and in trading cycles, but the real struggle for control is unfolding somewhere completely different, in power plants, data centers, and government boardrooms. While retail investors debate whether Bitcoin will hit a new all-time high, entire nations are quietly racing to secure mining power, forming alliances, negotiating energy deals, and reshaping the future of the network without ever touching a cryptocurrency exchange. This is the new face of Bitcoin, a global competition for hashrate dominance, and the Bitcoin Hashrate War 2025 is becoming one of the most important and least understood shifts in the entire crypto space. To understand why this matters, you have to look at how mining has changed. It's no longer a hobby, it's no longer a side business, and it's no longer controlled by scattered independent operators. Mining has become industrial, strategic, and geopolitical. Governments are treating mining like digital energy infrastructure, the same way they once treated oil reserves, manufacturing plants, and semiconductor production. And as energy-rich nations step in, mining influence is no longer measured by who owns the most Bitcoin, but by who controls the machines that secure the network itself. The rise of crypto mining national strategy began when countries realized Bitcoin mining solves two massive problems at once. First, it monetizes unused or stranded energy, turning wasted power into a financial asset. Second, it stabilizes energy grids by absorbing excess supply when demand drops. For countries with fluctuating energy production, this is a breakthrough. Instead of losing revenue, they convert it directly into Bitcoin. This is why oil-rich nations, hydro-powered regions, and geothermal active territories are entering the mining sector aggressively. Mining is no longer about chasing profit. It's about transforming energy into economic influence. But what makes 2025 different is that nations are no longer acting alone. They're forming coordinated alliances. Some are working with private mining companies. Some are partnering through sovereign wealth funds. Some are building joint mining infrastructure across borders. These alliances are not publicly advertised, but their effects are visible in the rapidly rising hash rate. When new industrial-scale facilities go online, the difficulty jumps. And the mining difficulty shock crypto analysts are watching right now is one of the fastest increases in Bitcoin history. Mining difficulty climbing so quickly creates unexpected consequences. Smaller miners get pushed out because they can't keep up with rising energy requirements and hardware competition. But unlike past cycles, this time the network doesn't lose power, because national-backed miners don't shut down. They keep running even when profitability drops. They aren't mining for short-term rewards. They are mining for long-term strategic positioning, and that changes the economic landscape of Bitcoin completely. Now let's talk about the deeper motivation behind this shift. Nations entering mining are not just seeking profit, they are seeking optionality. In a world where inflation, currency devaluation, and geopolitical tension are increasing, Bitcoin mining offers a way to accumulate Bitcoin without buying it on open markets. If a country tries to purchase billions of dollars worth of Bitcoin directly, the price would skyrocket instantly. But mining allows accumulation quietly, gradually, and without triggering market panic. It is the silent accumulation strategy that most retail investors aren't thinking about. This brings us to the next critical point, the changing distribution of hash rate. For years, mining was heavily concentrated in a single region. When that region imposed a ban, the industry relocated across the world. Today, mining is far more distributed, but that doesn't mean it's less competitive. It means the competition has entered a new phase. Instead of one dominant location, multiple powerful regions are now vying for influence. The United States, the Middle East, Russia, Central Asia, South America, and parts of Africa are all expanding mining. And each region has its own reasons: energy economics, political strategy, sanctions workarounds, or technological ambition. Meanwhile, mining hardware evolution is accelerating. Next-generation ASICs are more efficient than ever. Immersion-cooled facilities operate like advanced data centers. AI-powered optimization reduces downtime and energy waste. Mining is merging with high-tech infrastructure, and nations with access to cheap, scalable energy, nuclear, hydro, solar, geothermal, natural gas, are becoming the new global mining superpowers. So what does this mean for Bitcoin's future? First, the network is becoming more secure than ever because rising hash rate increases attack resistance. Second, miner selling pressure may decline because government-aligned miners are less likely to liquidate. Third, difficulty will continue rising, forcing out weaker participants. Fourth, the price could experience new kinds of supply shocks, not from halving events alone, but from long-term miner accumulation. But there are risks. If mining becomes heavily concentrated in a few coordinated regions, questions about decentralization will intensify. Political tension could spill into Bitcoin infrastructure. Regulatory pressure could attempt to influence mining operations. Even though Bitcoin cannot be controlled directly, miners still play a crucial role in transaction validation and security. This is why the Bitcoin Hashrate War 2025 matters. Not because it threatens Bitcoin, but because it reshapes who participates in securing it. Now let's talk strategy, because understanding mining dynamics gives investors an edge. Rising hash rate during sideways price action has historically been a bullish signal. It means miners are confident enough to invest in future rewards. Tracking miner reserves can indicate upcoming supply pressure or accumulation. Watching difficulty adjustments can help predict when weaker miners are exiting. Monitoring energy-focused announcements can reveal expansion zones before the market reacts. And keeping an eye on which nations are entering mining can forecast long-term geopolitical alignment around Bitcoin. As we wrap up, here's the bottom line. The future of Bitcoin will not be determined by traders, influencers, or short-term market cycles. It will be shaped by who controls the infrastructure behind the network. Mining has become a global competition, and the players entering now are not looking for quick gains. They are positioning for the next decade. And the investors who recognize this shift before the mainstream catches on will understand Bitcoin not just as a digital asset, but as a strategic global resource. So stay prepared, stay informed, and don't underestimate how quickly this mining transformation is accelerating. Thank you for watching, and I'll see you in the next video.